I don't think it's possible to deglobalize, and I'll tell you why. There's certain product categories, once they become commodities, are better manufactured in low-cost countries.
Yeah.
And the idea that you shouldn't manufacture socks in Vietnam because of some protectionism or the fact that you'd rather pay 5 times more for socks, that makes no sense whatsoever. Yet, if you're building a new chip that actually can fuel AI, artificial intelligence, yeah, I can see I'd rather do that domestically and keep that away from our economic competitors like China, who don't want to play in a level playing field unless they're willing to cooperate. And that's the leverage we have over them. So, different product categories. And I would argue energy, we should remain self sufficient. That was a mistake the administration made. Prior to the election, the country was completely independent in terms of energy production in oil and gas. And obviously, pipelines were shut down, policy changed. And I think that this current administration realizes they went too fast, too soon, and now we
Mm.
have to pedal back. I'm not trying to play politics, but it'll be reflected in the midterms in just a couple of weeks. Yeah, I've been quite an investor in the Miami market now for 6 years in terms of my allocation of real estate investments. I would say one thing about real estate that's unique as a sector. Now, normally portfolio theory would say this: no more than 20% in any one sector, no more than 5% in any one position. That has
Mm.
been a standard in the indexing market for sovereign wealth and pension plans for 100 years. And I abide by those rules in most of the mandates that I'm involved in managing, with the exception of real estate. In
Yeah.
our operating company, our holdings in real estate now are at 39%, which
Well,
is significantly, it's a heavy overweighting. And the majority of that is in Florida, where are very positive and constructive about the demographics that are occurring there. Now, I've heard all the arguments about Miami sinking underwater, and I get all that. We've been talking about that for 100 years, and there is always that risk in any coastal investment. We haven't seen a 15% correction in any markets yet. There's fundamental demand, obviously, and the consumer remains buoyant. But you're right, we could have that. Traditionally, the real estate cycle used to be 7 years. That has gone, we haven't had a significant correction. I don't care what market in North America you look at, for 25 years. And that's because of change in demographic and demand for housing, both rental and assumed ownership. But you gotta look at it this way: real estate cycles are really interest rate sensitive, as you detailed. But these mortgage rates right now are still traditionally very low if you go over a 40, 50-year period. I've been an investor in real estate when interest rates are 15%, 1.5. I've been an investor when mortgage rates were under 4. And so at the end of the day, fundamental shelter and housing and office space and demand, industrial demand for real estate, remains a constant in any economy at different levels of trajectory. But as an asset class, it has proven to be buoyant for hundreds of years. That's true, but it was a very, very short period, 18 months. And so when you think about an asset class like real estate, it is a very slow turn asset class. The entry and exit fees are very high. You
yeah.
don't flip it, you don't trade it. You really have to think about the cap rate is reflecting. And what I would agree with your statement in '08 with the financial crisis was cap rates went up. And so it's the inverse. So if you buy a building at 4.5% cap rate, which was AAA office towers in Boston in '08, yeah, they spiked up a bit for that 18 months, but there were very few trades in that market. So, these assets people think very long term on. Now, I would
Mm.
agree there's a new reason to consider cap rates going up in industrial and commercial real estate. That's because of new trend in work environments, which are not so focused on office anymore. For most companies now, they have flexibility, and up to a third or half of their employees never come back to the office. And that's probably permanent, particularly in sectors like technology. So that may put some pressure on cap rates for commercial, which means their values go down. If cap rates go up, the building's worth less because you're giving it to a poorly managed government who goes and wastes it up for you. That's what's happening in Massachusetts. That's what's happening in New York. There's a
Yeah.
reason these places are uncompetitive. Look at San Francisco. Walk around downtown. That is a war zone. Los
Yeah.
Angeles, a war zone. It's a complete
Mm.
collapse in society because what they've done is they've broken management. They have no way of managing those anymore. They've squandered their resources, they've squandered their money. California is a disaster. Great place to visit. Wonderful to take that drive down the highway, but I wouldn't touch it as an investment. And at night, my goodness, I wouldn't wear any of my watches out. That place is
Yeah.
I wouldn't even walk in San Francisco at night. It is literally a war zone. You wouldn't recognize it anymore. What I say is the lesson that every investor learns over a lifetime of investing, it is 100% impossible to time the market.
Yeah.
100% impossible. Everybody's tried it. Everybody's had their fingers burned. And I'll give you an example over the last 3 weeks. And so if you looked at 2020, which was an extremely volatile year as we started to understand what COVID was doing to the economy and the global economy, the entire returns of that year, which was actually a good year for equities, happened in 19 trading sessions. 90% of the returns happened in 19 trading sessions. That's 8 hours times 19.
Wow.
And if
Yeah.
you were not in the market that day when it went up 1,200 points or 800 points or 1,500 points or whatever happened in the volatility, you had no returns whatsoever. The problem is which day. And I remember in March, April, May of 2020, when I was in Miami in lockdown, unlikely what happened in Britain would occur in our market. I'll tell you why. The parliamentary system has a lot more volatility. It is a system that works, but the prime minister is elevated by their caucus, by their cabinet. Same process in Canada. I'm familiar with that system because I once ran for prime minister in that country. I'm a Canadian. I'm Irish. I'm also just recently become an Emirati. And so I'm familiar with these different systems. But in the case of the British prime ministership, her caucus, her actual cabinet elevated her to prime minister. She made 3 bad mistakes. And look, it happens. Politicians make mistakes all the time. But when the bond vigilantes came out, which is when you talked about the Guild, their treasury exploded and interest rates went up immediately. That was the market saying these policies don't make sense at this time. That's a great question, but it's self-indexed in this sense. Think of it this way. When you look at foreign capital, well, let's say Norway or the United Arab Emirates or Saudi Arabia, these very, very oil-rich jurisdictions that seek to diversify away from just one sector. It's not that they hate energy or they don't hate energy, they just have too much of it. And so when indexers, and I'm an indexer, and there's many people do what I do, when we're requested to build indices for countries like Saudi Arabia or the United Arab Emirates or anybody, a pension plan, and they say, look, we want to own the S&P 500 without oil, without airlines, because we have our own airline, we have our own oil, obviously, so we want diversification. Now, indexing for a country like Canada, here's the point I want to make. Canada versus the United States is an investment. Canada is uninvestable, and it doesn't get indexed anymore because the politicians there are unable to stop gridlock. So if you want to invest in a pipeline or a big R&D project, or you want to do something in mining or copper or commodities or paper or wood, you just get litigated out of the country. And that's why so many companies have left Canada. I think it's great. I wouldn't have paid what he paid for it. I would have thought there'd be a better price. I think that stock is worth $12 without Elon's bid. It's a poorly run company. It's a poorly managed company. No shareholders ever made any money on that till he came along. So once again, he's proven he can make money for shareholders if you were a Twitter shareholder. But prior to his bid, it was a rotating doors of managers that would just option themselves with millions of options, dilute the float, and cash themselves out. And 36 months later, they got whacked and a new manager came in. All of that wealth just went to the insiders in that company. The board was totally useless. They didn't even use the platform. Try and find a tweet from a board member. I mean, I hate to be critical, but these are facts. So if I were him, I would simply take a spatula and scrape that place clean and start from scratch. Figure out a way to monetize it, maybe bring in a payment system. Who knows what he's going to do? It's always a good time to start a business. It's actually historically proven now that many businesses started in chaos and declines, and periods like 08, 09 ended up flourishing and becoming huge successes. I mean, desperation is mother's milk of necessity in terms of figuring out what to do next. And great entrepreneurs know how to pivot. I think what we learned about the pandemic and the companies that survived in my portfolio figured out a way to use technology, go direct to consumer right across the board, where margins were significantly better. And the data they're collecting now is significantly better than they used to get from retailers or just selling through Amazon. So I would argue that catastrophic outcome of a global pandemic made a lot of companies a lot stronger. And today we're having one of our best quarters ever and some of our best cash flows ever, because so much of our sales are now at full margin, direct to consumer with information. where we talk about a ACH transfer between banks or SWIFT transfer internationally, these were private sector innovations decades ago that were heavily regulated by global governments. And for the first time now, products like stablecoins could really disrupt that at a significantly faster, more productive, more transparent, more auditable, but above all, far less expensive system for
Mhm.
transferring global assets. And so you're going to see companies like Circle headline at uh, at that event, and I think it's going to be Davos will be all. You're going to see a lot of crypto-based conversation at a global level with global governments as they struggle to find some kind of policy and regulation. And that bill, the Stablecoin Transparency Act, is at the forefront of that. That is a bipartisan U.S. bill that I think could be marked up by the time we get to that place, because it'll be after the midterms on November 8th, which is going to be significant for crypto policy. I think what will happen in the House will help crypto policy. But I think all of this is going to be really fascinating, and why everybody should stay on their toes. Lots of change coming.